This week was a wake-up call for investors everywhere, a stark reminder that the financial markets can change direction in the blink of an eye. The sense of unease was palpable, as headlines flashed red and portfolios took unexpected turns. For many, it was a lesson in humility, a moment to pause and reconsider what it really means to invest in a world that's always in motion. The stock market isn't a guaranteed path to riches, and this week proved it. Even seasoned investors felt the sting as values dropped and uncertainty crept in. The dream of easy gains faded, replaced by the reality that risk is always part of the equation. After months of soaring tech stocks, reality hit hard. What goes up, comes down. The relentless climb of technology giants had lulled many into a sense of security, but the market's correction was swift and unforgiving. It was a sobering moment for those who believed the rally would never end. News outlets buzzed with updates, and social media was flooded with anxious posts as people tried to make sense of the sudden downturn. The collective anxiety was impossible to ignore, spreading from trading floors to living rooms across the country. On Friday, December 12, 2025, a sharp sell-off erased recent gains, especially in tech. The Nasdaq, once the darling of the market, saw its value tumble in a matter of hours, leaving investors scrambling to reassess their positions. The Dow, S&P 500, and Nasdaq all took major hits, signaling a shift from risk-taking to seeking safety. The red numbers on the ticker told a story of caution, as investors pulled back from speculative bets and looked for stability. This wasn't a random event. It capped a week of growing anxiety and a clear rotation out of tech into value stocks. Analysts debated the causes, but one thing was clear. The market was searching for balance after a period of excess. Investors questioned sky-high tech valuations and sought safer havens, highlighting the necessity of diversification. Gold, bonds, and other defensive assets suddenly looked attractive again, as people remembered the importance of spreading risk. Conversations everywhere shifted from excitement to concern. Friends, families, and colleagues all asked the same question: what happens next? The uncertainty was a reminder that markets are driven as much by emotion as by numbers. The mood flipped from euphoria to fear almost overnight, showing how fragile market confidence can be. Optimism gave way to caution, and the rush to buy was replaced by a rush to protect what remained. Now is the time to be deliberate and ensure your financial house is in order. Review your goals, check your emergency fund, and make sure your investments align with your risk tolerance. If you don't control your money, the market will. Take this week as a lesson. Stay informed, stay diversified, and remember that true wealth is built over time, not overnight. Let's look at the numbers behind the turmoil. This week, the financial markets experienced a dramatic shift, leaving investors and analysts scrambling to make sense of the sudden downturn. The volatility was evident across all major indices, with sharp declines and heightened trading activity. As we break down the data, it becomes clear that a combination of economic signals and investor sentiment drove the market's steep decline. The Nasdaq, known for its heavy concentration of technology stocks, plunged 1.69% on Friday, nearly 400 points, capping off a week where it fell 1.6% overall. This sharp drop wiped out billions in market value, sending shockwaves through the tech sector and beyond. Headlines flashed red as investors rushed to reassess their positions, and the mood on the trading floor turned tense. The S&P 500, a broad measure of the market's health, also took a hit, falling 1.07% on Friday and losing 1% for the week. This decline came just after the index had reached a record high, highlighting how quickly market sentiment can shift. Investors who had been celebrating gains only days before were suddenly faced with mounting losses and growing uncertainty. Even the Dow Jones Industrial Average, often seen as a more stable benchmark, wasn't immune. It dropped 0.51% on Friday. However, unlike the other indices, the Dow managed to eke out a 1% gain for the week, thanks to earlier strength in value-oriented stocks. Still, the day's losses underscored the widespread nature of the sell-off. This divergence between indices reveals a key trend. Investors are rotating out of high-growth technology stocks and moving into safer, value-oriented sectors. This shift is often seen during periods of uncertainty, as market participants seek stability and lower risk. The rotation has led to significant changes in portfolio allocations and has impacted the performance of different sectors. Meanwhile, Treasury yields have been on the rise, with the 10-year yield topping 4.18%. This increase signals growing concerns about inflation and the possibility of higher interest rates in the near future. Rising yields often prompt investors to rethink their strategies, as bonds become more attractive relative to stocks, and borrowing costs for companies begin to climb. Higher yields make it more expensive for companies to borrow money, which can slow down expansion plans and reduce profits. This added pressure is felt across the market, especially in sectors that rely heavily on financing. As a result, both corporate leaders and investors are watching interest rates closely, knowing that further increases could trigger even more volatility. The broad sell-off, combined with rising yields, reflects deep anxiety among investors. Many are worried about the potential for a prolonged downturn, and the uncertainty is fueling rapid shifts in trading strategies. The atmosphere on Wall Street is tense, with many bracing for more turbulence ahead. In times like these, understanding the underlying market shifts is crucial for protecting your investments. Staying informed and adapting your strategy can help you navigate the uncertainty and avoid costly mistakes. Consulting with financial professionals and keeping a close eye on economic indicators can make all the difference. The numbers tell a story of a market on edge, one where every data point matters and every decision counts. As we move forward, staying vigilant and prepared will be key to weathering whatever comes next. Technology was at the heart of this week's chaos. Investors finally questioned the sky-high valuations of AI-driven tech companies, demanding real profits, not just promises. Disappointing earnings and unclear paths to profitability triggered a sector-wide sell-off. Rising interest rates made borrowing more expensive, squeezing tech companies' margins and making future earnings less valuable. The market rotated out of risky tech and into stable, dividend-paying sectors like healthcare and consumer staples. This is a classic shift from speculation to capital preservation. The tech rally's exuberance gave way to a painful correction. Investors are now prioritizing safety over hype. The lesson: hope isn't a strategy. Profits matter. When tech tumbles, the biggest names fall hardest. Broadcom dropped over 11% Friday despite beating earnings, as its AI profit outlook disappointed. Oracle fell 6% Friday, adding to a steep decline after delays in key AI data center projects. Nvidia, the AI chip leader, lost 1.3% for the week, proof that even the strongest aren't immune. Alphabet and Meta also posted losses, impacting countless portfolios. The reasons? Doubts about AI profitability, high valuations, and a broad move out of growth stocks. No company is immune to a shift in sentiment. The tech sell-off was swift and widespread. Investors are demanding real results, not just big promises. Volatility is the new normal for tech. Even in a rough market, some companies shine. Lululemon soared nearly 10% after smashing earnings and raising its outlook, proving quality wins. Strong brand, loyal customers, and solid execution set it apart. Even CEO news couldn't dampen the rally. Rivian jumped 17% after unveiling new AI tech and a self-driving upgrade, showing innovation still excites investors. These winners show that strong fundamentals and real products can defy market gloom. In a punishing environment, investors reward clear, tangible progress. Not all sectors move together. Look for quality and innovation. Individual stories matter more than sector trends. Even in a sell-off, opportunity exists for the prepared. Cannabis stocks staged a stunning rally this week, catching many investors and analysts off guard. The catalyst? Reports surfaced that President Trump is considering reclassifying marijuana to a less restrictive federal category, a move that could have sweeping implications for the entire industry. In response, shares of Tilray skyrocketed by 35%, Canopy Growth surged 25%, and Aurora Cannabis jumped 23%. These are massive double-digit gains for a sector that's been battered by years of regulatory uncertainty and market volatility. For investors who have weathered the storm, these sudden moves feel like a long-awaited reward. But they also raise new questions about what's next for cannabis stocks and the broader industry. If marijuana is reclassified, it could open doors for scientific research, allow cannabis companies to access traditional banking services, and potentially pave the way for greater profitability. This shift would mark a dramatic transformation in the industry's outlook, making it easier for businesses to operate and innovate. Years of regulatory hurdles and legal gray areas may finally begin to ease, fueling a new wave of optimism among investors, entrepreneurs, and advocates alike. But it's important to remember, this is just a report for now, not a done deal. Policy changes in Washington can take time, and there's no guarantee that reclassification will happen soon or at all. Political headlines can spark wild swings in the market, especially in sectors as volatile as cannabis. It's easy to get caught up in the excitement, but betting your future on speculation is always risky. If you're thinking about investing here, use only money you can afford to lose. The cannabis sector is still unpredictable, and fortunes can change overnight. The potential for growth is enormous, but so is the risk. Every rally can be followed by a sharp pullback, especially when news and rumors drive the action. Stay cautious, do your research, and don't get swept up in the hype. It's easy to let emotions take over when stocks are soaring, but discipline is key. Smart investing means balancing hope with reality, especially in a market as unpredictable as this one. Keep your expectations grounded, and always make decisions based on facts, not just headlines. The Federal Reserve cut rates for the third time this year, aiming to boost the economy. Cheaper borrowing should fuel growth, but not all Fed officials agreed with the move. Internal dissent signals uncertainty about the economy's true strength. President Trump is already eyeing new Fed leadership, adding more unpredictability. The market hates uncertainty, and a potential change at the Fed is a big wild card. Rate cuts are meant to fine-tune growth, not signal panic. Investors are torn, relieved by cuts, but wary of what's driving them. The Fed's actions and leadership will shape the market's next moves. Volatility reflects this tension at the heart of the market. In turbulent times, expert opinions flood in. Bulls say buy, bears say beware. UBS remains bullish, predicting the S&P 500 will keep climbing thanks to a strong economy, Fed support, and AI growth. They see the tech sell-off as a healthy pause, not a crash. Bears, meanwhile, warn this is just the start of a bigger correction, pointing to cracks in tech and Fed uncertainty. They urge caution, raising cash and avoiding risky assets. Both sides look at the same facts and see different futures. Navigating these views is one of investing's biggest challenges. You must filter the noise and stick to your plan. After a volatile week, don't panic. Long-term plans shouldn't be derailed by short-term swings. Review your portfolio. Are you diversified or overexposed to one sector? Now's the time to rebalance methodically, not react emotionally. Watch company guidance, inflation data, and Fed signals for real insight. If you're young, downturns are buying opportunities. If you're near retirement, focus on capital preservation. Stick to a plan made in calmer times. Don't let headlines knock you off course. Discipline and perspective are your best tools. Stay strong, stay smart, and stay in control. The market's noise fades, but your strategy endures.